Japan is the world's second largest holder of foreign reserves. As of September 2024, Japan's foreign reserves is over $1.25 trillion. This figure has increased tremendously over the past 2 decades. What's interesting about this graph, however, is that this occurred during Japan's so-called lost decade, where the economic growth has stagnated. Yet, the country continued to record and received billions of dollars every single year in foreign reserves. Comparatively, they are also just behind China, which has total reserves amounting to over $3.7 trillion. They are ahead of other countries like Switzerland, which has $952 billion, India with $708 billion, Russia at $633 billion, and Hong Kong with $461 billion. Being the second largest holder of foreign reserves brings tremendous numbers of benefits to one's economy. This is why Japan is one of the most stable countries today. But before we talk about its benefits, it is first important to understand the drivers of Japan's foreign reserves. We'll try to understand why Japan holds one of the world's largest reserves, and then discuss the economic impacts to Japan. But before we understand all these, it is also crucial to understand what a foreign reserve is. Foreign reserves are assets held by a country's central bank or monetary authority in foreign currencies, bonds, gold, and other international assets. Most of the assets held by Japan, however, are denominated by the United States dollar. And that's because the US dollar serves as the world's primary reserve currency, accounting for a significant portion of global trade and finance. Here's a table published by the Ministry of Finance of Japan. As shown, they hold over $1.25 trillion in official reserve assets. The largest component of these is the foreign currency reserves, totaling $1.09 trillion, and it is divided into 2 categories: securities and deposits. Securities are the largest component of Japan's foreign currency reserve, valued at $938 billion. These securities are primarily US Treasury bonds and other foreign government bonds. Bonds are basically a form of investment. The Japanese government lends the money to foreign government in exchange for periodic interest payments and the return of principal at maturity. Holding these bonds allows Japan to earn a steady, albeit modest, income, which contributes to the stability of its foreign reserves. For a rough calculation, if Japan had invested all of these $938 billion into US bonds, they would receive approximately $18.76 billion in annual interest income, assuming an average yield of around 2%. The second component in Japan's reserve assets are deposits. Over $159 billion are deposited in 3 different places, but nearly all of it is held with foreign central banks and the Bank for International Settlements, BIS. The BIS is basically called a bank for central banks. Then, there's also the IMF reserve position, although the figure is just a small sum of $11 billion. This is followed by special drawing rights amounting to nearly $60 billion, and then there's also gold at $71.5 billion. Finally, there's also other reserve assets and other foreign currency assets. Now that we have a clear understanding of Japan's foreign reserves, let's talk about how Japan came to become the world's second largest holder of reserves. A country's foreign reserves is primarily driven by its consistent trade surpluses, where exports exceed imports. Here's a graph of Japan's value of exported goods and services over the years according to the World Bank. In 2022, this figure amounted to a massive $894 billion. That figure alone is much more than many countries' GDP out there. As a matter of fact, Japan is one of the world's largest exporters of goods and services. It is ahead of countries like France, Netherlands, South Korea, Singapore, and India, all countries that exports massive amounts. In categorical terms, Japan's largest exports are vehicles, This amounts to over $157 billion. Following this is machinery, nuclear reactors and boilers at over $129 billion, and then electrical and electronic equipment at $101 billion. A long list of other goods are exported from Japan to many parts of the world. These exports have then allowed Japan to generate a trade surplus. A trade surplus happens when exports exceed imports. Basically, when a country exports a good or service to another country. For instance, Japan selling its vehicles to the United States. The US then pays them through US dollars. But in the same way, Japan also imports goods and services. For instance, Japan buys energy products. When Japan buys them from the US or any other country, they have to pay them in US dollars. This exchange of goods and services is then called trade. The more goods and services Japan exports, the more US dollars it can keep in its pockets. This is the major reason why Japan has seen a rapid rise in its foreign reserves. It kept exporting more than it imports. Its automotive vehicles from Toyota, Mitsubishi and Nissan are major reasons why Japan is one of the world's largest holders of foreign reserves, because global demand for them is so strong. Here's a graph of Japan's net trade in goods and services in balance of payments as published by the World Bank. It shows that from 1996 to 2010, Japan has recorded surpluses, big surpluses. If you take a look at the data again from when Japan had received record amounts of foreign reserves, you see that it was during those years of trade surplus that drove the reserves to rise. Unfortunately, in recent years, Japan's balance of payments hasn't been doing well. That's because of Japan's continuous reliance on energy imports, which have seen a rapid increase in prices over the past few years. Further, some commentators also mention that Japan's exports have seen competition lately, especially for their automotive vehicles, where companies like Tesla to Chinese electric vehicles have been battling Toyota and other major Japanese car makers for sales. This is a good explanation as to why Japan's foreign reserves haven't really kept rising, and why it's even going down for the past few months. Another good reason for the increase is a concept called net primary income. It plays a substantial role in influencing Japan's foreign reserves, especially given Japan's strong position as a global investor. Net primary income refers to the difference between income earned by Japanese residents from foreign investments and the income earned by foreign entities from investments in Japan. Net primary income consists of earnings Japan makes from its overseas investments. These earnings include interest payments on foreign securities such as US Treasury bonds, dividends from Japanese-owned companies abroad, profits generated by Japanese subsidiaries in foreign countries, and returns from various other foreign assets, like property or royalties. Here's a graph of Japan's annual net primary income in balance of payments, and it's massive. In 2022 and 2023, they recorded about $250 billion per year, which goes to show just how well they have invested overseas. It's quite obvious, especially knowing that companies like Toyota dominate Western markets. The profit Toyota gets from selling cars in the US then goes back to Toyota, or Japan. Finally, foreign direct investment, FDI, inflows also plays a role. As one of the world's most stable economies, Japan attracts a substantial amount of FDI every single year. Here's a graph of Japan's FDI, net in its balance of payments according to the World Bank. It is again massive. Every single year, the country records hundreds of billions of net FDI balances. That is why, even though trade hasn't been doing well, there are other sectors like FDI and net primary income that helps balance all their payments off. Now, let's talk about the most important piece of the video, the economic impact. One of the most important uses of Japan's big foreign reserves is currency stability. For decades, Japan's yen has always been seen as a safe haven, although recently its slide has made investors think otherwise. However, for the past few decades, it's always been seen as one. One big example as to how this played out was during the 2008 global financial crisis. The Bank of Japan, BOJ, had intervened to prevent the yen from appreciating too rapidly by buying US dollars and selling yen. Japan's foreign reserves allowed it to carry out these interventions without risking economic instability. One thing that you should know as to why having the yen appreciating too rapidly is bad is because of its direct impact on Japan's export-driven economy. When the yen appreciates too rapidly, Japanese goods become more expensive for foreign buyers, reducing global demand for Japanese products. This hurts Japan's major industries, particularly automotive and electronics, which rely on competitive pricing to maintain their global market share. As a result, companies like Toyota, Sony, and Panasonic could see reduced profits due to weaker international sales. Another important factor here is receiving investment returns. As we just mentioned earlier, Japan is a big holder of the US Treasury that generates substantial returns. This steady income supports Japan's balance of payments and helps offset deficits in other areas. Finally, the most important one here is offsetting trade imbalances. As we just saw, Japan's trade balance hasn't really been that good, mainly because of lower demand for Japanese goods and rising energy import costs. In 2023, Japan even recorded a massive $68.3 billion in trade deficits. Here's a graph of what they imported for that year, according to the United Nations Comtrade database. It shows just how much they import in oils and fuels. By having a big foreign reserves, however, they can manage these import costs without risking currency instability or economic strain. But anyway, do let us know what you think. Thanks for watching.